ladies and gentlemen, good morning. First of all, I'd like to welcome His Excellency Dr. Mohammed Zubair, Professor Pierre Fardier, Vice President of Sorbonne University, Dr. Ahmed Nagadi, Vice President of King Abdulaziz University, Dr. Abdullah Al-Khatib, the Saudi Cultural Attaché in France, and Dr. Antonio, the President of Tezkiya University in Indonesia. I'm so pleased to have this opportunity to welcome you all at the third monthly seminar between King Abdulaziz University and Sorbonne University. At this seminar, Dr. Sami Al-Suwailen will present a paper that is related to a very important topic, namely Islamic approach to risk. Secondly, I would like to express my great appreciation to the remarkable impact that the Center of Islamic Economics at King Abdulaziz University is placing on the growing global recognition of the significance of Islamic economics. This is of course due to the great support that the center is receiving from the upper management of King Abdulaziz University, represented by Professor Osama Tayyib himself, as well as the great effort placed by the senior management team of the center, represented by Dr. Abdullah Urboun, Dr. Ibrahim Al-Suwailen, and Dr. Muhammad Al-Gharar. Finally, I really wish all the success for the seminar, as well as all the project, and especially the research project that the center is undertaking. And I really invite all the people, all the interest party from the public sector to support this project. Hopefully we will inshallah see the year of 2012 much more inshallah better than 2011, and I really hope that this seminar will be a fruitful conclusion to the year of 2011. Thank you for attending this conference in both parties, here and in France. Thank you.
Thank you, Professor Sam, for this nice talk. I'm very honored today, of course, by the presence of our president, ex-president of King Abdulaziz University, Professor Zubair, among us. He is at the same time an Islamic economist, or the founder of this knowledge. So it is very honorable day that we have him among us, alhamdulillah. To introduce the topic and the speaker, I would say that the aim of this monthly seminar are multifold. One important goal is to introduce the Islamic perspective in several issues in economics. Particularly today's seminar will put into discussion the Islamic perspective to risk. Risk is an important challenge to the industry of financial products, either to Islamic or conventional industry. While risk management industry was developed to reduce and avoid risks in the financial market, it has been argued that more risks were in fact created and concentrated in the industry. The international financial crisis erupted in the US and developed into currency and sovereign crises, raised concern about the validity of the current techniques and instruments to reduce risks. Alternative techniques, instruments, or ways of thinking are all welcome to save the financial system if it could. In this context comes Dr. Sami Ibrahim paper to be discussed today. Dr. Sami's Ibrahim paper is part of his book titled Hedging in Islamic Economics, in particular chapter 4 and 5, and he's going to be presented today. In the introduction of his book, Dr. Sami says, I quote, Islamic financial industry is growing rapidly. Markets are increasingly appreciating Islamic instruments, and more institutions are willing to provide Islamic services to their clients. Yet, Islamic instruments, particularly in the area of hedging and risk management, are not at pace with the industry's growth. Let us, ladies and gentlemen, introduce to you our speaker today, Dr. Sami Ibrahim. I start by saying that Dr. Sami Ibrahim main advantage is that he has good understanding of the two important fields of study that makes good Islamic economists, economics and Sharia.
MashaAllah.
Dr. Sami Ibrahim, he has BSc from Saudi Arabia, King Saud University, MA from South Illinois University, and PhD from Washington University, Missouri, 1995. He was the first recipient of Hyman Minsky Prize for distinguished performance in macroeconomics in 1994. His work experience is in private sector and international organization, the academia. He was working for the Rajhi Bank for more than 6 years, and then in IBB since 2004 till today. Today he is the manager. He is the manager of Islamic Financial Product Development in the IBB. Dr. Suwailen published several papers and books on Islamic economics and finance in Arabic and in English, estimated to be more than 30 publications. To mention some of these titles, Decision Making Under Uncertainty, an Islamic Perspective, Optimal Sharing Contracts, Property and Evolution, Islamic Economics in a Complex World, and finally, Behavioral Complexity. Having said all of that, I would conclude with an interesting idea from Sami's paper, where I'm quoting, uncertainty and risk cannot exist outside human mind. Good, Sami.
Thank you, Mr. Chairman. Bismillah ar-Rahman ar-Rahim. I am honored to be in this distinguished gathering of intellectuals and experts here in Jeddah and in Paris as well. Actually, many of our colleagues thought that the lecture is in Paris. Well, it's over the on the air. It will be inshallah there. I hope, by the way, the communication is very well. I hope you hear us well and communication going fine, because sometimes at the middle of the session you realize that there was no connection or something like that. I'll try to be focused as much as possible. The topic, of course, is quite rich and challenging, and I consider this, as I mentioned in the paper, it's a work in progress. It's never done, it's never completed, but it is a step-by-step approach, trying to build some kind of pillars or stones to reach more understanding and better picture, complete picture, as much as possible for the topic. Let me start first with a few remarks on the framework for studying risk. First of all, risk as such. Okay, let me start. Okay, let's first define what is risk. In the literature, there are, in general, two definitions of risk. One would say it's the likelihood of failure or loss. Okay, chances of loss or failure. This is the most relevant from our perspective and probably more accurate within the framework that we are examining. The other definition is volatility, standard deviation. This is more general and it is also helpful, but it depends on the context. For example, you could have volatilities in profit. So as long as you are in the positive, it doesn't matter, are you making 10% or 50%? There is a volatility, but you are still making profits. So that's not a serious issue. But when it is likely that you make 10% or minus 20%, then that is the first definition of risk, which is the likelihood of loss or failure. So we will, from now on, we will focus on this first definition. So risk in this context will be the likelihood or probability of failure or loss. With this meaning, obviously risk is not an objective of Islamic finance, although sometimes it might be misunderstood that it is an objective. That's not true. It's exactly the opposite. One of the objectives of Sharia is to preserve wealth. Hifd al-mal is an objective of Islamic economics. So preserving wealth is the objective. So being exposed to risk in this meaning or in this definition cannot be an objective in it as such. So when we see instructions or requirements for Islamic transactions in which someone or the seller, for example, has to bear the risk of the good or the asset, it is not that because risk itself is an objective. The objective is to be responsible for that asset and therefore take care of it. And we will see how this would balance incentives and what is the function of risk. So risk is, as such, is not an objective. Just like in Sharia there is a discussion whether hardship or difficulty and Musharakah, is it an objective of Islamic Sharia or not? Of course, many scholars would say hardship as such is never an objective. The divine scripture will never make being in difficulty is something that is yes, praised in Sharia. Allah Azza is the most merciful, so it would never be an objective to expose people to hardship. The same thing could be said in financial transactions, that risk as such cannot be an objective. Now hedging, this is a widely used term. In general and in principle, hedging means to minimize risk and take precautionary steps to avoid losses. That's in principle perfectly consistent with Sharia objective. There is no question about this in principle. The issue is how. It's the devil is in the details. So we always need to know how this objective would be reached. Okay, so what are the functions of risk? Risk is important to discipline, okay, agents. Now imagine, and we are in a university, so imagine that in one course the instructor would say to the students, everybody will pass the exam, no one would fail. What would be the incentive for students to study? None. There will be virtually no incentives to. Of course, some students might still have some incentive to, but there will not be enough incentives to study. So being exposed to the risk of failure would give incentives to students to study hard and work hard. The same thing for business and economics. If an agent, an entrepreneur faces the risk of failure, he will do everything he can in order to make his project success. So it's very important for discipline. And believe it or not, in the crisis, although there were so many instruments to shift the risk, like credit default swaps and all these things, the banks could shift the risk to someone else. At the end, when the crisis hit, banks were loading more risk than they were before the boom, before the bubble started. So these instruments, I mean, if someone wants to shift the risk, there is still the incentive to make profits. So risk would balance the incentive for profits. So you want to make profits, but because you face the risk, you have to balance your approach. But if you are not facing any risk, then you have more incentives to make profits and do more and more and more to get profit as much as possible. And then you end up, knowingly or unknowingly, building up and loading much more risk. And of course, that's what we mean when we say risk implies responsibility. If I bear the risk of this machine or this property, I'll take care of it. I will preserve it, I will improve its value and so on, because I am exposed to the downside of this, so I have the incentive to raise its value and make it more valuable. Risk also is a source of information. Suppose that nobody gets sick. How much would be our knowledge in medicine and how the human body works? It will be very negligible, because nobody gets sick. Only when we get sick, we start, so when we see that there is a problem in the liver, and we start seeing so many things happening in the body, now we know that this is the function of the liver, to do this and that. And when the liver failed, we realize that, well, the liver was doing X and Y. So that's how we learn. So risk is a source of information, or more accurately, failure is a source of information. So being exposed to probability of failure, that means we are given more incentives to learn and to gather information, of course, to avoid risk. So it's very important for learning. And everyone knows the slogan that those who successful people are those who have been failed before. Those who failed are more likely to succeed than those who just keep succeeding every time. You cannot learn if you always succeed. You will never learn. You have to fail once, twice, or 3 times. We all know these stories about entrepreneurs. So finally, risk is a source for creativity. When you do a mistake, you realize that it doesn't work this way. So is there any way I can do it in another way? When they realize, well, yes, there is a way I can do it in a different way to avoid that risk. So it's a source for innovation and creativity. Without failure, if everything goes smooth and perfect, why to innovate? Why to create? There is no reason to create. And that's why institutions who are making very good money, they will never look for creative ways to produce product. Why should they? Why should they bother? So there is wisdom behind the existence of risk, and within this wisdom, we have to realize that we cannot avoid risk completely. Now, if we move to the next, sorry, I'm not moving this perfectly well, but they have it on paper, right? راح 10 minutes, 8 minutes. أنا مسجل.
لا تحسب كثير.
أنا قايل لك ما حد. Okay. Right. Fallacy of composition. So what does fallacy of composition mean? Fallacy of composition means I can do something by myself, but if everybody wants to do it, it will fail. Okay? I can, for example, cheat in the exam, and this will, if I do that and nobody catches me, I'll get a good grade and be happy that I'm holding a degree. But if everybody is cheating, everybody knows that this school is a bad school, therefore degree will be useless. So it's self-defeating. That's what fallacy of composition means. Now, if everybody wants to avoid risk, what would happen to the economy? It will collapse. If nobody wants to take any kind of risk, there will be no economic activities, no production, no trade, no wealth creation, no nothing. So, but if someone else is taking the risk, it pays for me to avoid the risk. So I'll shift the risk to Dr. Hussam. As long as he's taking the risk, I'm making money, I'm happy. As long as someone else is taking the risk. If everybody wants to avoid the risk, it will not work. It will not work if everybody wants to avoid the risk. Now, what if the majority avoids the risk? What if most of us say, okay, we'll go to Dr. Abdurrahim. Dr. Abdurrahim, all of us will make a contract with you. We will shift our risk to you. What would happen? Now, risk is concentrated. All of our risks now are concentrated in one place. So now the likelihood that any of us would be affected would be higher, because the probability that one person holding all the risks, if he fails, the whole society or community would be affected. And if the majority wants to avoid the risk, not only it will be concentrated, it will be interconnected. So before we make a contract with Dr. Abdul Rahim, my risk and Dr. Ahmed's risk was independent. We were separate from each other, and independent from each other. But when we both go and shift our risk to Dr. Abdul Rahim, now we are interconnected through Dr. Abdul Rahim. And that's what is exactly happening. 5 banks in the US dominate 90% of the derivatives. So you can imagine this problem of too big to fail because the risk has been concentrated on only few banks. If one bank fails, not only, actually, if you read the story of long-term capital management in 1998, that hedge fund, the Federal Reserve intervened to prevent its failure. And in the document, they said that we fear that if this fund failed, the international markets might get disrupted. So not only the US economy, which is the largest economy in the world, might be affected, even world economy might be affected. A single institution. And that's what happened now in this crisis. Few institutions, when they fail, the whole world markets are affected. So systemic risk would be higher. Oops. So there is a dilemma in risk. Wealth creation always involves risk, but excessive risk would negatively impact performance. Capital is coward, so to speak. So too little or too much risk of risk would kill incentives. So how to differentiate good risk from bad risk and where to draw the line? So in principle, from an Islamic point of view, risk must be integrated with ownership of goods and services, whether they are tangible or debt. Like in Salam contract, it's a debt contract, but it is part of a real transaction, part of trade. So as long as risk is part of trade, or production, or real transaction, or ownership of goods and services, that would be a legitimate risk. Risk must be subordinate to real wealth creating transactions. As we said, it's not an objective in itself. Trading pure risk is gambling. Trading without any kind of risk is riba. So you can see how riba and gharar, or riba and gambling, they are two faces actually of the same coin. So it must be the case that neither of them would be acceptable. So if one wants to make profit absolutely without any risk, that would be riba. If someone wants to trade pure risk without any kind of underlying asset or ownership, that would be gharar. So Islamic finance, from our perspective, of course, balances strike the balance between these two ends. So let's get into gharar. Gharar means, in Arabic language, it means risk with delusion. Okay, it's not purely risk, it's risk with a kind of deception. Okay? Okay, there are two levels of gharar. First, the degree of risk, and the second, the form of the contract. You can think of it that ex ante and ex post. Degree of risk, this is before the transaction is realized, before uncertainty is realized. And then after uncertainty is realized is the form of the contract, or the distribution of the payoffs. So it is two levels. There are two levels of gharar, and this will help us greatly, of course, analyze the concept. Now, we already said risk is probability of loss. If you read what fuqaha or scholars of Sharia mentioned, you will be, I think, from my point of view, I was surprised how accurate these statements were. For example, one definition, gharar is the thing that has two possibilities, the most likely of which is the most feared. So you have something that has two possibilities. The more likely is the most feared, which means loss. So loss is more likely. So that's one definition of gharar. The other one, whatever that has equally likely existence and non-existence. So the first one, loss is more than 50%. Okay, probability is more than 50%. The second one, 50-50. So if you combine both, you end up with the definition that anything that has probability of loss 50% or more that would be Gharar. Of course, when we say 50%, it's not that sharp. We have to add the margin of confidence, because we all know our statistical information is itself uncertain. So we have to have a margin for confidence. So it's not 50 sharp, because our knowledge, our estimation of these probabilities itself is not sharp. So we have to add a margin for confidence. But conceptually, this would help us understand the topic. So Gharar occurs when probability of loss is greater than or equal to probability of gain. Okay, we are now 16 minutes away. Now, in a lottery, that's a very obvious example. Someone buys a ticket, lottery ticket. Let's say if the prize is 1 million. Okay, and each ticket has the price of $1. So what's the probability that if you buy one ticket, you will win the prize? It is 1 in a million. So it's extremely likely that the buyer of the lottery will lose, because the chances to win is 1 in a million. So is extremely likely to lose rather than to gain. So where is the delusion here? Why would a rational person get into a decision that is more likely to lose than to gain? The source of delusion is the size of the prize, because the size of the prize, 1 million, this is the source of deception. Our human weakness towards profits and making wealth, this will deceive us into getting into a transaction that is more likely to lose. So that's where prohibition of Gharar comes in. A rational person shall not get into this, no matter how big the prize is. If it is more likely to lose, you should not get into the project or into this decision. And of course, if it is more likely to lose, that means to win, you simply depend on luck. You are not depending on skill to make the chances more likely in your favor. So this will kill incentives, of course, to work hard. And that's why we need feasibility studies in order to assess the feasibility of the project that we want to invest in. Now, this is a very important issue for those who study economics. Okay, the first thing you see in microeconomics when they talk about uncertainty, they use the expected value, and then when they calculate the lottery, you realize, well, it looks like rational to buy a lottery ticket. So this is quite uncomfortable. If we, and many are, by the way, prohibition of gambling is not only in Islam. In all divine faiths, gambling is prohibited. It's not only for Islamic finance, and this is also for Riba or Uja. Okay, the most common is the mean or expected value. But there is a different rule, which is the median. The median is the value with probability of at least 50%. Of course, one could develop many other criteria for decision making. I'm not saying the median is the only alternative to the expected value. But I'm saying this is one example of how a statistical criteria makes a big difference in decision making. Now, I will not get into these issues. I will move forward all the way to the slide talking about these are very important, but okay, okay, this is the distribution of the lottery. So, if you use the expected value, okay, and assume that utility is linear, how much would you give a price for the lottery ticket? Okay, from an economic point of view, say this is a lottery of 1 million, and there are tickets, we have 1 million tickets. How much would you pay for one ticket? If you use expected value and assume utility is linear, the price of the ticket is $1. So the price is positive. And this is the maximum price, of course. So it is rational to pay $1 or less to get into the lottery. But if you use the median rule, the price should be 0. You are not supposed to pay anything for this lottery. And you can see the difference. So the median rule would say you are not supposed to pay for lottery. the expected value says you can pay up to $1. So, of course, this is not to say which is perfectly right or wrong, but we can easily see which rule is more consistent with the Islamic view that gambling and lottery is unacceptable from Sharia point of view. Now, of course, as I said, one can develop other alternatives, and in the paper you can see you can still use the expected value approach, but you can add a constraint that probabilities of gain are greater than probabilities of loss. So there are many ways that one can avoid the problem of gambling. Only this is an example of how can one find an alternative decision rule under uncertainty. Now, there are many things that are lottery-like returns. What does lottery-like returns mean? Means that you have something that is more likely to lose, but if it wins, you win big. Okay, you are more likely. This is a project, a kind of project, or a kind of investment, or a kind of transaction. The agent is more likely to lose, but if he gains, he would win big. That's the lottery-like return distribution. Subprime loans were such an example. Banks were aware that when they give mortgages to subprime borrowers, that those borrowers are more likely to default. They knew this. It's not that they didn't know about it. They knew, and that's what they called it subprime. They called it sub because they knew that those borrowers are high-risk borrowers and they are more likely to fail and to default. But they were betting on, of course, the rising prices of houses and so on. So this is a lottery-like return. It's more likely to default, but if it wins big, because as prices are rising, and the bubble is the same logic, by the way. Everybody knows the bubble has to explode. Everybody knows the bubble has to stop. But everybody is saying, well, maybe I can win before the bubble explodes. Okay? This is, of course, not acceptable. And there is a hadith that says, before the day of judgment, there will be a mountain of gold discovered in the Furat river. Okay? يحسر الفرات عن جبل من ذهب فيقتتل عليه الناس يهلك من كل 1990 كل يقول أنا الذي أنجو. So the hadith says that there will be a mountain of gold discovered in Furat, and people will start fighting to get that gold. Out of every 1,900 would die. Everyone says, I am the one who gonna win. I'll be from those 10%. So 90% chances to fail, only 10% chance to win. But of course, it's not acceptable. And that's when he says, if you live until that point, never go to that mountain of gold. Never try to get it. Toxic acids are the same. If you read about toxic acids, these are toxic acids created by those collateralized debt obligations when they create those different tranches. And the most, the more risky of these tranches are called toxic acids. They are not rated, and they knew very well that these are, they called it toxic, so they knew that these assets are more likely to fail. But the return on these assets is very high. And that's why it was so. I think from this point of view, for policy making, it should be very clear that toxic assets should not be allowed. Because these, we now know very well how negative the impact of. Okay, I'll skip because there are so many details, probably not much time. Okay, now the second level of Gharar is the contract design, the exports evaluation, or the payoff structure. Okay, the pure gambling, or the most pure form of Gharar, is zero-sum exchange with uncertain payoff. Zero-sum means one party would win if and only if the other party loses. It's impossible for the two parties to win. And this is very clear in gambling. Gambling is very clear. If someone flip a coin, and I say to Dr. Ahmed, if it is head, you pay me 1,000 riyal or 1,000 euros. If it is tails, I pay you. It's a zero-sum game. There is no way that both of us would win. And there are so many examples and traditional fiqh resources about these zero-sum games. Lottery, of course, is another example. Now, based on this concept, we can classify transactions to three categories: pure zero-sum games, pure positive-sum games, and those that are mixed. Now, zero-sum deals, we already talked about it. One party can win if and only if the other party loses. And this is a tree, so to speak, decision tree. We have two parties, A and B, and there are two possibilities: either to have a head, we flip the coin, or tail. So if it is head, A would pay 1,000. So that's why you see the first number is minus 1,000, because A would pay 1,000. The second number is plus 1,000, which means B would gain 1,000, and the opposite in case of tail. Now, it's very important how to know something is zero-sum game. This is done through something called backward induction. Okay, you assume, you ask the two parties, you come and ask me and ask Dr. Ahmed. Suppose you know in advance it will be head. Okay, would you accept to get into this transaction? So if I assume that heads I win, Dr. Ahmed would fail, would lose. Then if they ask me, if you know in advance that it will be head, would you accept to play this game? Of course I would say yes, I would accept. But Dr. Ahmed would say no. If he knows in advance it will be head, he knows he will be losing, so why he should be playing this game? There's no reason to play this game. So we put plus and minus, okay, to indicate that I'll be happy to play this game. That means I will gain, put plus. But Dr. Ahmed will not be happy to play this game, so we put minus. Okay? Now, we ask the second question. Suppose we know in advance it will be tails. If we flip a coin, it will be tails. Would you accept to play this game? If they ask me, of course I would say yes or no. No, I would refuse to play. Dr. Ahmed, of course, would be happy to play. So we put plus for Dr. Ahmed and minus for myself. Now, if you have all outcomes in the game, plus minus, that means all outcomes are zero-sum outcomes. This means the whole game is zero-sum. It's impossible for anyone, for the two to win together. So this will be pure gambling. This is the most pure form of Gharar. This is how to know, how to evaluate whether a transaction is zero-sum or no. You start from the end and go backward. You assume that, suppose we know what would be the result, then would we accept to get into this transaction? Okay? If we apply this to commercial insurance, Sharia scholars almost unanimously agree it is not acceptable. So if you apply the commercial insurance, you will realize that ultimately it will be, because to simplify it, you assume that there are two cases. Either there is an accident or there is no accident. Okay? So there is, and we have two parties, of course, the buyer of the insurance policy and the seller of the insurance policy. The buyer is the customer, and the seller of the insurance policy is the commercial insurance company. So you ask the two parties, suppose you know in advance that there will be an accident during the period of the contract. Would you accept to get into this contract? The buyer would say, yeah, of course, I'd be happy, because the insurance policy would cost him, let's say, 500 euro or 500 riyal, but the compensation would be maybe 50,000 or 10,000. He would be, of course, better off buying the insurance policy. But if you ask the insurance company, suppose you know in advance that there will be an accident, the insurance company will refuse. Actually, they will refuse even without knowing, but if it is more likely, they say, no, you are high risk, we will not insure you. So we put plus and minus in case of an accident. In case of an accident, the buyer would be happy to buy the insurance policy, but the seller would refuse. Now we move to the second case. Suppose there was no accident. So they would ask, you ask the customer, suppose you know in advance that there will be no accident. Would you be happy to sign this contract? Of course, for the customer, there is no reason. If I know in advance there will be no accident, if I know in advance that my car will be parked in the garage for the whole year, why should I buy an insurance against a car street accident, let's say? So, of course, for me, I will not be happy to get into this contract if I know in advance that there will be no accident. Now, so we put minus for the buyer. Now you ask the company, would you be happy to get into this contract if you know in advance that there will be no accident? And of course, the insurance company will be extremely happy, and that's their objective. That objective is to get those customers who will never have accidents. Now, so you have two possibilities. In each you have plus and minus, which means there is no possibility of mutual gain. There is no possibility of mutual win. So it becomes a zero sum. And that is why commercial insurance is Gharar contract. Of course, the alternative is cooperative insurance, but that's a different story. The cooperative insurance becomes a kind of not-for-profit arrangement, and this will take it out from the sphere of for-profit transaction. Okay, so let's move now. I think I have 5 minutes more or so. Okay, the positive sum deals are transactions in which the two parties win together or lose together. So if you have a joint venture between A and B, if the venture wins, both are happy. If the venture loses, both will not be happy. Now this will be acceptable as long as the two parties are confident of success. So that's where the first level of Gharar comes in. We have to be confident that it is more likely that the venture would succeed. That means the win-win or the plus-plus outcome is more likely, and therefore the two parties will be happy to get into this contract. Now, these two extremes, the pure zero-sum game and the pure positive-sum games, are not the most common type. The most common are mixed deals. Now, these mixed deals, they have the two components, okay? They have a possibility of win-win, okay? And they have possibility of win-lose. It has two possibilities. If you remember, the zero-sum game, it's always plus, minus, plus, minus. There is never plus, plus. The positive sum deal, plus, plus, minus, minus. Here it is plus, 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 minus. So this is a mix, something in the middle between the two extremes. Now, this is the most common form of Gharar, which is, and this is where comes in the issue of Gharar Kathir, excessive Gharar, and Gharar Yasir. Let's take the example of Muzara'ah crop sharing. This is a contract between a landowner and a farmer. Now, you assume that there are two possibilities. This is only to simplify, of course. One can always make things complex, but we start with simple cases and then we move gradually to complicated cases. So we assume there are two cases, either a good season or a bad season. In case, first of all, let's make it clear. In a Muzara'ah contract, in principle, the farmer bears the cost of farming. Irrigation, pesticide, all these things are borne by the farmer. The farmer is responsible for the cost of farming. But the crop, the output or the outcome would be shared between the landowner and the farmer. Let's say 50-50 or whatever ratio they agree on. Now, in case of good season, the share of the farmer would be enough to compensate for the costs that he paid for this project, and therefore everybody would be happy. But in case of bad season, the share of the farmer of the output or the crop will not be enough to compensate him for the cost that he paid for the farm. So there is a chance that one party would win, the landowner, and the other party would lose if we look at the contract as such. But still, this contract, for the majority of scholars, is acceptable, or for many scholars at least. I know Dr. Ali will clarify on this. So for many scholars, this transaction is acceptable for a simple reason. Of course, scholars are not using game theory. We are using game theory simply to clarify, but the results are the same. This will be acceptable as long as the mutual gain outcome is more likely. The two parties they expect and they are confident that the mutual gain, that there will be a good season, they will have enough resources to compensate for the cost, and everybody will be happy. As long as this is the expectation of the two parties, then this will be an acceptable transaction. So to say that this is so this is a mixed game transaction. Okay, I don't in Paris you don't see this laser points, but you can focus on this these two outcomes, plus plus and plus minus. So as long as this plus plus is more likely than this, and as long as the magnitude of this gain here for the landowner is greater than the magnitude of the gain here in case of a bad season for the landowner. So for the landowner, it is more attractive to be on this side rather than to be on this side. So we have two conditions. One, the probability. This has to be more likely for a good season. The second is the magnitude of gain. The magnitude of gain here has to be at least as large as here, so that this outcome is as attractive, at least, as this outcome for the landowner. With these two conditions, this transaction will be acceptable. And in this case, this outcome, the less likely outcome, is called minor gharar. Okay, this would be gharar but yasir, because this is a chance that one party would win at the expense of the other. This should not be acceptable if that was the outcome, but this is not the main outcome. This is not the more likely outcome. This is the less likely outcome. So that's why it's minor gharar yasir, which is less likely in terms of likelihood, and this is less attractive in terms of magnitude. This is a risk that we have to take, because without taking this risk, we will not be able to get into Muzara'ah contract. So this is a kind of, this is what we say, that risk is subordinate to real transactions. The objective here is wealth creation, it's production. So as long as this is the objective, this is the more likely outcome, and this is the more attractive outcome, then the minor risk over there would be acceptable. Of course, this is a humble opinion, but that's, scholars frequently talk about gharar yasir and gharar kathir. And this is one way, this is not the only way, but this is one way to model excessive gharar and a minor gharar. Of course, if this outcome was more likely, if it were more likely that one party would win at the expense of the other, but there is a probability that the two parties would win, then this will be excessive gharar. This will be gharar kathir or gharar fahish, and then it will not be acceptable. Now, I don't think I have enough time, but if you go to, for example, sale of immature fruit, this will be an example in which you have an excessive gharar, in which if someone sells the fruit before maturity appears, then this outcome would be more likely. The plus or minus will be more likely, and there will be gharar fahish. Okay, and that's why the Prophet ﷺ put the condition that you have to sell after maturity start appearing. After the maturity start appearing, this outcome, the plus plus, will be more likely. Okay, so this condition would switch the balance between the mutual gain outcome and the unilateral outcome of the transaction. Okay, I think let me quickly jump to. Of course, Urboun is another example, and how to compare it with options. That's an interesting exercise. I'll leave it. So we have two levels of gharar. Okay, we already talked about this. This is in case of a mixed game. We have excessive gharar when zero-sum outcome is dominant, if it is more likely, and if the magnitude is more attractive. We will have a tolerable gharar or minor gharar in case of mixed games, if we have the opposite conditions, that the mutual gain is more likely and the mutual gain magnitude is more attractive. As we said, we have two levels of gharar: zero-sum games, or the payoff or structure, and the first level is the degree of risk. Now, zero-sum games are always high-risk transactions. It is always high risk, because if you assume that at best it is 50-50 for each party to win, like flipping a coin, it's 50-50. So if I get into a transaction, 50% I would win, 50% I would lose, this would still be Gharar, because Gharar is when you have 50% or more chances for loss. So even at best, if you have 50-50, this will not be acceptable. So zero-sum games are always high risk. Now, highest deals always can be transformed into zero-sum games, and this always happens. We can simply, to clarify the difference between speculation and gambling, we can use speculation when there is high-risk transaction, excessive Gharar. So it's a mixed game in which the win-lose outcome is more likely. That would be, this is just a suggestion. We are not saying that this is the right definition, but this is one way to differentiate between speculation and gambling. And we keep the word gambling in which you have purely zero-sum transaction. Now, the relationship between Riba and Gharar, we already hinted for this in the beginning. Riba would be a separation of time from real transaction. Interest is compensation for pure time, irrelevant or independent of the underlying, while pure Gharar, which is gambling, is a pure trade of risk, so it's separation of risk from real transactions. So Riba is to separate time from real transactions, while Gharar is to separate risk from real transaction. But in general and in principle, time and risk are two sides of the same coin. You can have risk only in the future. You cannot have risk in the past. So only if you have time dimension, you have risk. Without time, there will be no risk, of course. So time and risk are two sides of the same coin. So to prohibit Riba implies, prohibition of Riba implies prohibition of Gharar and vice versa. I'll stop at this. Thank you very much, Mr. Chairman. And thank you for listening. I hope the communication was fine. I'm glad to receive any questions. Assalamu alaikum.
Thank you. Very excellent. Thank you very much, Dr. Sami, for this being on time, in time, by the second. Thank you very much. And if you allow me, just for 3 minutes, our scholar Sheikh Ali Al-Nadawi will comment on Sami's paper, please.
Very grateful to Dr. Sami for his good presentation and representations and dedication for Islamic Economic Research Center in King Abdulaziz University. It is a good opportunity for me to give few words about the main objective of this research work, namely Islamic approach to risk. In my view, it is an excellent, critical and analytical article and a masterpiece of his work hedging in Islamic finance. Dr. Sami tried his best to explore the system of zero-sum games and speculative and gambling contracts based upon his theory, and expose the errors, defects, and adverse consequences and disadvantages of these kinds of prevalent transactions. Also, he focused on the significance of natural commercial risk as an essential and inevitable element in so many positive and legal contexts. And on the sound ground of Islamic Sharia, Dr. Sami explained the dimensions of contracts linked by the risk. There is a clear conclusion in his paper that Islamic Sharia condemns all the transactions deprived of position like options, futures, swaps, and exchange. In our opinion, zero-sum games have worst impact upon globally dominating financial crisis. Thank you very much.
Yeah, thank you, Dr. Ali. Our friends in France, Professor Faghadir, if you please, if you have any questions from your end, and then we will move to the ladies section of King Abdulaziz University for questions. Thirdly, questions will be given from this floor here in King Abdulaziz University. Please, Professor Faghadir.
Yeah, if you agree, I would like to ask a first question, which is about the decision criterion. Dr. Suwailem proposed to consider mainly the alternative which has the highest median, and in some cases one would exact a higher standard of safety. I'm not thinking of an alternative decision criterion, but of a complementary decision criterion. For instance, think of building a nuclear plant. Of course, you would exact a level of safety which would be more than just the more likely issue. Safety must be very close to certainty when you build a nuclear plant, inshallah. And hence, don't you think it could be a good idea to combine first exclusion of alternatives which do not offer a given level of safety, and then choosing among these dominant alternatives using the median criteria? More generally, I wouldn't like to be discussing about alternative decision criteria, but just asking Dr. Al-Suwailem whether he knows whether there are some research about putting the median or putting the decision criteria he alluded to into an axiomatic form, because this is the standard way to discuss economic decision, and as he is pushing forward a decision criterion, I mean the median, which is quite different from what is implied by expected utility, it would be very interesting to come back to the axiomatic principles of the decision. Now I ask the floor. Would you like us to ask questions sequentially, or do we bundle them, pack them together?
Yes, Professor Badir. Let's the other give their questions also, and then Professor Sami will respond to all questions together.
Okay, hence a gift pack with the ribbon around it. Il y a un autre micro? Bon. Merci Marie.
I can mention the name because I need to write the names for each one.
Introduce yourself. Assalamu alaikum. Maha Gabbani. I'm a PhD candidate in Islamic finance. I'd like to thank you, Dr. Sami Ibrahim, for your very instructive and very interesting presentation. I would recommend also for the present another. I read lots of your articles thanks to Dr. Abdurrahim Saati. There's another article about أدوات مبتكرة لمعالجة المخاطرة. This is techniques of risk management, which talks about al-kharaj bil-daman, the saying of Prophet Muhammad sallallahu alayhi wasallam, where you explain daman bila kharaj, that means gharar, and kharaj bila daman riba. You explain it very well. My question is, in page 22, you're mentioning that derivatives is a kind of zero-sum games. How about, I'd like to know your opinion about all the derivatives, Islamic derivatives, like calls, puts, Islamic hedge funding, Islamic swaps. I'd like to know your opinion. Thank you very much.
Assalamu alaikum wa rahmatullahi wa barakatuh. Bismillah ar-Rahman ar-Rahim. Thank you very much, Dr. Sami. Very informative paper and presentation. May Allah give us understanding of this very nice paper. Question is, and going back.
Can you identify yourself, please?
Sorry?
Can you introduce yourself?
Sorry.
Because I need to write the name.
Yes, Anas Patel, based in Paris and founder of 570 Asset Management. The question is related to this risk, managing risk. Usually we, economists define the role of banks, and especially conventional banks, as managing risk. managing risk over time. Given your presentation and this that the Riba and Gharar are separation of time and risk from real transaction, how Islamic economics would put in perspective the role of banks, especially with this type of managing risk, and especially the job of asset liabilities management, where on the one hand you have short and long-term liabilities like deposit capital and all that, and on the other side you have to invest on short and long-term assets. So how do you manage the asset and liabilities, and especially with this perspective of conventional banks? Thank you.
No more questions?
Maybe there will be more questions later, but I guess there's already something to think about.
Very nice. We can ask also the ladies section, Dr. Nasreen, if you have any questions from your side.
السلام عليكم. أسماء باهرمز. الحقيقة أشكركم جدا على المحاضرة الرائعة، وبالذات للمجموعة اللي هم ما هم تخصصهم اقتصاد زي حالتي. سؤال يطرأ علي هنا، سؤال صوت واضح؟
In English, please.
Oh, in English. Okay. I would like to thank you very much for this very clear lecture, particularly for those who are non-economists. We benefit a lot from it. I have just a question, or I'm just perhaps thinking wild about where does the installment business lie? Is it under Riba, under Gharar? What is the percentage of Gharar in the installment business? A lot of people now in Saudi Arabia particularly, I mean the business organizations, lure the young people into installments, to buy everything by installments. Just a question, I don't know if you can answer it or just think about it, all of us. Thank you. في سؤال تاني؟
Thank you, Dr. Abdullah.
Okay.
That's all.
Then our guest here, please, if there is any question, Dr. Salim. One. Ahmed.
Bismillah ar-Rahman ar-Rahim. Thank you very much to Dr. Sami and to the Islamic Center. At the same time, I'd like to ask regarding leverage. What is the relation between leverage and risk? Number two, regarding salam and forward sale, either forward sale or sales through installments. As Ibn Taymiyyah said, they are the same. They are the same because we submit the commodity in advance regarding the installment sale or forward sale, while the other will be later. In salam, we submit the capital or the price in advance, then the commodity will be delivered later. But always we used to talk about risk in salam while we do not mention it regarding forward sale. Thank you very much.
Another question from the father. Maybe you don't need the. You go ahead. Still.
Assalamu alaikum wa rahmatullahi wa barakatuh. I just want a small clarification about this Muzara'ah example that Sami gave. As far as I know, maybe I correct me if I'm mistaken, that in Muzara'ah contract, the landowner provide not only the land but also the capital for machinery, leads, seeds, and things, and the farmer only do the work like in Muzara'ah. This is what as far as I know. Correct me if I'm right.
One question? Okay.
I have some comments on some of Professor Sami. First, on page 4, he put some condition on the tolerable risk. Actually, this is the Fuqaha, especially Dr. Gharar, he mentioned this condition only for the permissible Gharar. And there is a difference between the Gharar and the risk. We should be clear about it. Not all the risk is Gharar, but almost all the Gharar there is a risk. So there is some kind of Gharar. Okay. All Gharar involve risk, but not all the risk is Gharar. So we should distinguish between the Gharar and the risk, where we could find some contract where the risk is permissible, like Aqd al-Ju'ala, while it is not, we cannot consider it Gharar, even though the uncertainty is very high. Other point is about the likelihood of failure, that you equate that with causality. Causality usually involves some logical explanation for the action and the reaction. While the likelihood, we don't have that connection, so we cannot equate that with likelihood. Also, you put a limit that the risk should not exceed the 50%, and you build that based on the definition of Gharar also. Of course, the Gharar, by the definition of Gharar, we find that some Fuqaha not limit the Gharar, it exceeds the 50%. It's more than that. Ma khabiya anka. Any uncertainty can be considered even for 90 or more than 90% on that. So we do not have any fiqh base to limit the Gharar to be, or the risk to be 50. So it can be more or less than that.
Not less than.
Not
less than.
Also, the way to measure the tolerable Gharar, that we should have the magnitude less when we multiply with the likelihood of that. Of course, to measure the likelihood or the probability, it's subjective matter. You cannot control it. It's based on the businessman and his expectation and his judgment on the outcome of the business. So we cannot say it must be 50%. That is. Shukran, Jazakallah.
I think we have some good number of questions that Dr. Sami can comment on for the coming maybe 10 minutes. If we have another round, we'll start again from France.
Thank you very much. Let me start with the comments of Dr. Pierre. The decision rule, I'm not aware, at least when I wrote the paper on hedging, that there's any axiomatic development of the median rule. And that's why I think this is a very high potential area for research. As you must know, it's not difficult to find a rule and then you derive the axioms leading to that rule. It's not difficult, but it needs some skills in math. I don't have these skills, so I will not get into that. But I think this is a very good area of research, not only for the median, for any kind of decision rule that would exclude lottery-like returns. And by the way, if you read into distributions, the kind of different, there are distributions with undefined mean. And I came recently across an article that for some distributions with undefined mean, the more you collect the data from that distribution, the more it is uncertain. The more the mean would be uncertain. And of course, if you get the maximum number of data, the mean would be completely infinity or undefined, totally undefined. So it's not the way that new classical theory present the world. It's normally distributed, and you only do these calculations for standard deviation and mean, and everything is perfect, and you just do. No, the world is much, much more complicated than that. In any case, from our point of view, I'm not aware for an axiomatic approach or any application or any study. I'm not aware. Maybe there is, but as far as I know, I haven't come across a research applying the median rule in decision under uncertainty. Now, of course, when you are talking about a nuclear plant, of course you have to take the magnitude of loss, and that's why I just mentioned the median as an example. Otherwise, you could still apply the expected utility rule, but with the constraint that probability of gain is greater than probability of loss. So you have two-level decision. First, you check the likelihood. Once you pass this, or the decision problem passes this test or this constraint, then you simply apply the expected utility rule. So it is a specialized or a sub-case of the expected utility rule. Again, I think this is a very good area for research, particularly for those who are doing PhDs and they want to develop. And if you go, by the way, to experiment done by Kinman and Tversky, you will find in the detail that people tend to make a difference on which is more likely and which is the cause. By the way, if you dig deep into these papers, you will find it. They don't mention it very explicitly, but you have to dig into it to find. And that's why I think this is a very interesting area for research. For Sister Maha, thank you for your comments. How about Islamic derivatives? If you mean Islamic instruments for managing risk, of course, the way to develop instruments for managing risk, it has to be non-zero-sum games. If you compare Urboun and fiqh, okay, with financial options, what is the difference? Okay, if you go to the slides, you will see a slide, of course, because of time, there was no time to get into it, slide number 38. Of course, there are mechanical differences, there are procedural differences. In Urboun, it has to be part of the sale contract, the good must be identified in the ownership of the seller, okay? But in options, usually this is not the case. But even if these procedural issues are there, there is a fundamental difference. In Urboun, it's a mixed game. The Urboun that Fuqaha talk about is a case in which a customer comes to a merchant and says, I'll give you 10% or 5% or 2% of the value of this machine, and I have the right to take it or leave it. If I leave it, I will lose this 2%. So you have a mixed game. If the customer goes ahead and purchases this machinery or this good, it's a win-win. It's a normal trade transaction. So it's a mutual gain. But if the customer changes his mind and says, no, I will not take this good, I will be losing my 2%, or the customer will be losing his 2% Urboun down payment, and this will be a zero-sum outcome. So the Urboun gain or Urboun transaction is mixed. It could have win-win if the customer goes ahead and purchases the good, and it could have win-lose if the customer decides not to take the good and therefore to lose the down payment. So as long as the customer is more likely, he thinks that he's more likely to take this good, it will be acceptable. And this win-lose probability or possibility would be minor Gharar. Okay? But if you go to options, if you try to apply the same thing for options, you say, I will apply financial Urboun. I'll do the same thing but for stock of Microsoft or the stock of Yahoo or whatever. Now, in using this in financial markets, if the buyer of the Urboun, okay, knows in advance, you apply the zero-sum measure, okay, you ask the two parties, the buyer and the seller. Suppose you know in advance that the price will go up. Would you accept to put a down payment? The buyer would say yes, of course, because as long as the rise in the price exceeds the margin or the down payment or the Urboun, he will be happy because he would sell the stock in the market for additional profit. But if you ask the seller, if you know in advance that the price will go up, would you accept? The seller would say, no, if I know in advance that the price will go up, why should I give it to you for a lower price? I'll keep it for myself. If the price goes up, I'll sell it for myself and make the profit for myself. He will make more money than from the Urboun or from the down payment. So, and you reverse, you ask the two parties again. Suppose you know in advance that the price will not go up or even will go down. The buyer would say, no, I will not accept to get into this deal if I know in advance that the price will go down. And the seller would say, yeah, of course, I'll be more than happy because I will make the gain, which is the Urboun. So it's a zero-sum game. So if it is a financial Urboun, it will be a zero-sum game. There is no way that the two parties can benefit. And that's why if you go to the paper, you will realize that 70% of options holders, okay, those who keep their call options in their portfolio until maturity, they are losers, okay? So that means the brokers are quite smart. Brokers would sell options only on those shares that they think the price will not go up. So you end up, if you buy these options, in 70% of the cases, the price would go down and the value of the option would go to zero at maturity. And these are studies that are already authenticated or cited in the paper. So you can go to these studies and see how. So it's a zero-sum game, and it is more likely actually so that's, if we are developing Islamic derivatives in this sense, then we are not moving in the right direction. So we have to be sure, if we want to develop instruments for risk management, it has to be non-zero-sum games. Okay, we start with a non-zero-sum game design, and then from there we go into the details and the procedures. But if the design itself is zero-sum game, there is no point in going in that direction. I'm not saying this is strictly unacceptable from Sharia. That's a different issue. But I'm saying as the best practice or the best approach to develop products, that's not the best way to develop products. The way to go ahead is to design, to look for products that would have mutual gain of the two parties as the more likely outcome. And then, of course, there will be a possibility of loss. And there will be a possibility, like in Muzara'ah, as we said, we'll come to that. As long as mutual gain is the more likely and the objective, it will be. Brother Anas' question about role of banks. Islamic banks should be part of real transactions, as most Islamic banks are, as usually the case. They have to be involved into buying and selling, leasing, etc. Now, the issue of assets and liabilities, that's of course a very problematic issue. To borrow short and lend long, we all know that this mismatch, maturity mismatch, has been one of the root causes of the crisis, because banks were borrowing overnight and they were lending for 30 years for the mortgages. And they are rolling over daily. Actually, some data shows, some papers show that 25% of the balance sheet of the major banks, investment banks, which is about 1 trillion, rolled over daily, overnight. Every day they have to roll over $1 trillion. So you can imagine how this can work. This system is extremely fragile. And of course, it's not sustainable. This cannot be a stable system. So we have to, and that's why after the crisis, many regulatory authorities like the Financial Services Authority and others, they developed some kind of measures to measure the maturity mismatch, at least to minimize this maturity mismatch. And I think from an Islamic point of view, this is a very dangerous and very high risk situation. It cannot be, it cannot fit nicely with the principles of Islamic finance. Dr. Asma is asking about, Dr. Asma is asking about installment business. Is there a kind of gharar? And the answer is yes. If the customer is not confident that he will be able to pay the debt on time, then he is getting into high risk business. If he's saying, no, it will be fine, inshallah, one day I'll wake up and I'll get a promotion, or my real estate will double in value, or my few stocks in Sabiq will get triple. Of course, or I'll try to roll over. That's even be more, it will have both now, Riba and Gharar. Rolling over will make it Riba, and because he's not confident to pay on time, it will make it Gharar. So yes, and that's why in the Sharia, debt, even an Islamic debt, like installment debt, is not desirable. And the Prophet ﷺ used to seek refuge from debt, and يستعيذ من الدين. The Prophet ﷺ used to avoid as much as possible getting into debt. And he used to discourage his companions not to get into debt, even though this is an Islamic, legally Islamic debt. Yes, but because there is a risk always that someone might fall into by being unable to pay, then it will become an issue. Dr. Ahmed Stambuli raised a good issue about the difference between the risk in salam and the risk in installment sale. And this is a very good question. In salam, the debt is a commodity debt. It's an in-kind debt. For example, wheat. But in an installment sale, the debt is money. Now, money is much more available than wheat. If you compare how much wheat is there in the market and how much money in the market, how much liquid is wheat, how much liquid is gold or money or currency, of course you will realize that currency or money is much more available, much more liquid than wheat or whatever, or salt or whatever commodity that has been contracted into salam. So fuqaha, they were aware, implicitly at least, that there is a difference, and these goods or commodities that are contracted in salam might disappear from the market. They were very aware of that, and that's why they put conditions into salam to be sure that this commodity will be available at maturity, and therefore it will. And that's why they say the salam debt is unstable, غير مستقر, غير مستقر, while the installment sale debt is stable because currency is much more liquid and much more available. Of course, there are chances that currency will disappear. For example, and God forbid you wake up that morning and the central bank says, sorry, this paper is worthless now. You have to either find some other currency or whatever. There is a chance that money will disappear, but a very, very small chance compared with the chance of a problem with the wheat or whatever commodity to be contracted for salam contract. And that's one area, I think, of research, the implicit economic conditions in fiqh books, because this statement, this debt is unstable, غير مستقر, and this debt is stable. This implies a statement about the economy. Okay, this is so when you say this is acceptable, so you have normative statements based on positive statements, but these positive statements are implicit. So I think that would be a good exercise to go into these texts and try to figure out or collect or extract the positive statements. Dr. Shashi comment about Muzara'ah. If the two parties agree, that's fine, but they still could have the agreement that the farm would be responsible for the cost. And Dr. Ali might correct me on that. As far as I know, it's a normal condition in Muzara'ah that the farmer would be responsible for the cost of farming. Dr. Saadi made good and philosophical comments on Gharar versus risk. This is true, but if you go to the definitions of fuqaha, they make it clear Gharar is a kind of risk. Gharar huwa al-khatar, and they may keep saying that in various occasions.
In contracts, in some bilateral contracts.
The likelihood of success versus causality, you are right. I'm not saying it is the action. Okay, the action would be a kind of causality. It's not full causality. Causality is a very complicated issue. Never get into that. But I'm saying it is playing the same role, because if you do this, you're expecting this to happen. Okay, so from Islamic point of view, a cause is something that is more likely to have the result. If it is less likely, it is not, practically it's not a cause. Of course, philosophically it could be a cause, but practically it is not a cause. From where is there a sub-basis for the 50%? I already cited the basis. It's if you go to a Gharar book, it's there. I'm not inventing anything. This is from pure fiqh texts. If مستوى فيه الوجود والعدم. It's more equally likely existence and non-existence. So this is 50-50. You don't have to be too complicated to realize it's 50-50. When they say
this is
ما
for the Gharar, but for the risk is different.
we're talking about Gharar. We are talking about Gharar here.
But you
Gharar is a special kind of risk.
Use it risk and Gharar is the same meaning.
That's what the fuqaha is saying. Gharar is a kind of risk. Al-Gharar هو الخطر الذي and so on. They keep saying this. It is already in the Arabic version of the paper. Because I knew some colleagues raised this issue that the fuqaha are talking about Gharar are not talking about Khatar. That's not true. Fuqaha were very clear that Gharar is a kind of risk of Khatar with these conditions 1, 2, 3. So you're right, risk is very broad.
Wider.
Yes, but Gharar is a subset. So it's a kind of risk.
It is a risk.
It is a risk.
Special
Yeah, with special conditions.
Contracts that
no, but these are not two different things.
When you sign a contract with somebody with no enough information, we consider that Gharar contract. But when I buy some commodity and I do not know in the future, this is risk but not Gharar. Say I'm buying this in cash, speculating its price will goes up, but it doesn't. So this is a risk, but not Gharar. But if I am you making a contract and there is some hidden information, uncertainty, this is Gharar, and this is the forbidden.
Well, I respect your point of view. There is no issue. It's not. This is not done. This is a subject of area of research, and I certainly welcome it. Thank you, Mr.
I don't know if you have a minute or so, Professor Ghadir, if you have a question from your side. Comments. By the way, I need to say that we have Professor Ghadir. He's an expert in risk. So we are talking in the same level of understanding, inshallah, with Ghadir. So questions, please, if there is any questions or comments from France.
Est-ce qu'il y a d'autres questions? Oui, s'il vous plaît. There is at least another one. Hence, thank you for taking another question.
Dr. Jouaber, Kauthar Jouaber, head of Islamic Finance Program at University Paris Dauphine. Definitions of risk, the probability of loss, and also the volatility of returns. And you focus on the first definition, probability of loss. So I wonder if the second definition, volatility of return, is a more general definition. It includes the first one. It includes also the probability of loss. And it's a very important issue for economic and for finance. So my question is how Islamic economics deal with the volatility issue. What about hedging volatility? What about defining this kind of risk? Thank you very much.
More questions?
يقول يتعبوك.
تعبهم راح يا دكتور.
أو شوف ذات الإجابة. اسأل به خبيرة.
Okay, Professor Ghadir, shall we ask the ladies section?
Thank you. No more question.
Then I will ask Sam, if you can respond to the question.
The volatility measure could be more general, but it's not always doesn't match the risk or likelihood of loss, because as I mentioned in the beginning, if you have a volatility of return, okay, so it is a volatility in the upside. So you don't know whether you're going to get 5% above and over your capital, 10% or 20%. So there is an uncertainty on the upside. That's where the two measures of risk are different. The first definition of risk is likelihood of loss. What you care about is the downside. Okay, and that is what is more important from the Gharar point of view, or the definition of Gharar and how to characterize Gharar. But as long as you are making profits and you are recovering, you are not exposed to loss, then the volatility, of course, you can still hedge using Islamic instruments. But from a conceptual point of view, what matters is the loss dimension. Of course, you can use hedging instruments as long as these hedging instruments are non-zero-sum games. And let me give you an example. Let's say an Islamic bank would provide Musharakah financing to a company, okay? And the bank wants to hedge this kind of risk with a third party, let's say an insurance company. And this example, by the way, is in the full paper. You will find it in the instruments section. So the bank can sell either his entire stake in the company or part of it for a deferred price with a defined markup, let's say to an insurance company or to a third party. In this manner, the bank is hedging its investment in this company. It's getting a predefined return, and that's perfectly acceptable as long as the share in the company, as long as this company is an ongoing business, and therefore the share of the bank or the investment of the bank in this company for managing risk and providing protection based on mutual gain or non-zero-sum games, that will be really something of value to the industry and to the world, by the way, because everybody wants to have win-win. I mean, only gamblers they want to win-lose, but the majority of normal investors they are looking for mutual gain. So as long as we are using non-zero-sum game instruments, we will be able to do it, but we need a specialized institution to be able to do this. Islamic banks, at least at this stage, they are not in that kind of business. They are in the business of providing financing, and then they want to hedge. So they are hedgers, okay? Now, to hedge means to shift the risk or to avoid the risk. That means someone else has to take that risk. So who's on the other side of the equation? Who's taking the risk? Right now, the one who are taking the risk are big international banks. And of course, they are using their own conventional instruments, or they are using semi-conventional. They're Islamic, but modified to be almost identical to the conventional. So that's an area that we need to develop institutions to really be able to manage risks, to take risks, but using Islamic instruments and non-zero-sum. Thank you.
Well, thank you, Dr. Sami, for your comments and lecture that you just read. I'm sure that this seminar will be a positive sum game. Then I would ask Professor Faqadir if you please can conclude from your end after thanking, of course, the Dr. Sami and the brothers here and the ladies in the legislation KU and France. Please, Professor Faqadir, if you can conclude.
Yeah, thank you, Abdullah. I would like to thank you again for both the great lecture and the very focused answers you gave us today. This discussion should be continued to lead to advances in research and to publishing these answers, I guess. The chair will provide the proper means to collaborate efficiently. Dr. Nagadi, Vice President of King Abdulaziz University, joined us today, and I'm sure he will have ideas to support this joint research activity. Today is a very special day for me, and I would like to invite you to share my points. It's not just that 13 years ago I defended a PhD dissertation about the concept of risk. By that time, it was not even known in Europe that the word risk itself was of Arabic origin. My friend Sylvain Piron, who is a historian with the École des Hautes Études en Sciences Sociales, has shown since then how the Italian merchants borrowed the concept of risk and the word itself from Arabic merchants in northern Africa during the Middle Ages. And from this point, the word and the use of the word spread all over the world. Today, we are going back to the source of risk as a concept. And the concept itself is not risky, it's not dirty, although what risk implies is a problem, as we have seen. Since 1,000 years, every people over the world, over the whole earth, had come to be acquainted with the word risk and to better understand that world because of that concept, which was given by Arabic merchants 1,000 years ago. This example sets the perspective of our common future. I mean, we would like to provide mankind not just with concepts to say what things are, but with theories and solutions to solve economic problems for the next 1,000 years. Dr. Suwailen, you provided us today with very deep thoughts and understanding of the concept of risk and the techniques that we can use to mitigate and hedge it. I hope your thoughts will help us for the next 1,000 years, inshallah. I think it's over for today.
Okay.
See you next time. Thank you very much.